Amazing. We are live. I will just wait a couple of seconds-ish as people trickle in. But in the meantime, as you come in, please feel free to say hello in the chat, introduce yourself, where you're tuning in from, and be sure to switch the message to all attendees so that everyone can see your messages. We'll wait just a few seconds while people trickle in, and then we'll get kick-started with today's fascinating webinar. Right. Well, as we wait for all the latecomers to show up, essentially, we can kick off. So hello, Finimizers, and welcome to another Finimize Live. So my name is Reda, an analyst here at Finimize, and I'm really, really delighted to host today's event on game-changing strategies for options traders with our partner, IG. Now, before we get started, just some housekeeping rules to go over. So first of all, like I said, as you come in, please feel free to introduce yourself in the chat, tell us where you're tuning in from, and remember to switch the message to all attendees so everyone can see it. Second of all, you're going to see a poll pop up. Please fill it out so we just get to know you a little bit better. And then third of all, the format of today's webinar is it's going to be a 15-minute discussion with our guest today, followed by a 15-minute audience Q&A, which takes me to my fourth and final point. Please use the Q&A box in Zoom to ask a question. And if you see a question that you like, please upvote it so it moves to the top. And that way we can go through the most upvoted questions first. So without further ado, let's kick off. So for those of you who don't know, IG is a leading retail trading and investment platform, providing ambitious, self-directed individuals with the products, technology, and insights they need to access financial market opportunities, and they've been doing this since 1974. They offer an easy-to-use platform, expert trade ideas, and friendly support as standard. They allow you to trade over 17,000 different markets with spread bets and CFDs, invest in thousands of global shares and ETFs, and trade thousands of US listed equity options. And to help put you in the best possible position to succeed, IG provides an array of analytical tools and content, as well as educational resources, including IG Academy, completely free of charge. Now, an important disclaimer, spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. So 70% of retail investor accounts lose money when trading spread bets and CFDs with IG. You should really consider whether you understand how spread betting and CFDs work and whether you can afford to take the high risk of losing your money. And also, options and futures are complex instruments, which also come with a high risk of losing money rapidly due to leverage, and you could lose more than your original investment. Now, with that out of the way, today I'm very excited to have IG's options sales trader, Hannes Bruwer. So, growing up in a farm near a small town where life was about outdoors and animals, a far cry from investing and trading, Hannes discovered his love for the financial world after various jobs ranging from barista to assistant accountant. After graduating at the University of the Free State with a master's degree in economics, he joined IG, where he completed the graduate program and started his career as an options sales trader. His goal has been to learn as much as possible about markets and options, and is a firm believer in the saying that jack of all trades, master of none, is often better than being a master of one. Hannes, loving the intro. What a great turnaround in terms of life, and great to have you here. How are you doing today?
Hi, Rida. Yeah, thank you for having me. I'm doing quite well. Yeah, thank you.
Amazing. Thank you. Well, let's kind of dive straight in and, have some questions I kind of want to go over in terms of different sort of option strategies and so on. And the first one I really want to talk about is something I hear about a lot, which is a covered call option strategy. And I always hear that this is a great way to generate additional income from shares you already own. Sounds really good. So can you just perhaps explain how the strategy works exactly, what risks it involves, and how investors can effectively implement it?
Sure. Yeah, so in this case, usually when we talk about a covered call, that's usually the what they call the gateway drug for options trading. That's usually how people get started. But first thing that you need to know is there are basically two aspects involved in a covered call. So a covered call consists of owning shares of a specific market and then selling calls against those shares to generate additional income. So this is specifically useful in a flat or a moderately bullish market where the price of the stock is not expected to move significantly. So, in order to have a covered call, you need to have the same amount of options contracts as you have shares of in multiples of 100. So, saying that, I don't mean that you need to have 800 shares in exactly 8 contracts, but you can't have 80 shares and one short call or 120 shares and two short calls because you're not fully hedged. It needs to be in multiples of 100. Now, risks associated with this would be the price increasing significantly or decreasing significantly. If it decreases by quite a lot, so below the strike price that you sold the call for, you would still have the premium that you received, even if the shares that you hold end up being almost worthless. So, and this means you still get some money out of that if your shares essentially become worthless. The other risk would be the market price increasing significantly past your strike price. This means that you could end up losing your shares that you would be assigned. And what that means is essentially you are capping your profits. So it means that you're losing out of the potential profit if the shares would increase past that strike price. But in this scenario, you would still have the premium that you received. And if you did have a strike price above the original price that you bought the stock at, you would also then make that profit on top of that. Now, the different ways of implementing this would usually just depend on the broker and the platform. Now, you can usually do that individually, either buy the shares, then do the call, or sell the call, then buy the shares. But a lot of the times, if they do allow short options, it would require you to buy the shares first and then sell the calls against that.
Sounds really good. And just something I'm kind of thinking of in terms of a follow-up, because you say, option contracts typically cover 100 shares. And let's say you wanted to implement the strategy on a particular stock with a really high absolute dollar share price. I'm looking at Amazon, for example, almost $4,000. So 100 shares, that's going to be $400,000. So is there a way to kind of implement this covered call strategy if you cannot afford to own or buy 100 shares of the underlying stock?
Yeah, so this is a strategy that I absolutely love. It's what's called a poor man's covered call. Now, how that works is you would buy a backdated long call that's much further, that's got a further expiry, and that would be in the money. That's essentially it's going to almost mirror the share price in the movement, and then you would sell covered call against that. Now, what that does is essentially gives you the synthetic exposure of the stock with a deep in the money long call, and it also hedges you for that short call. So this is much cheaper because you only have to pay the premium for the long call instead of that full notional value of the stock that you're looking to do. And the nice thing about this strategy as well is your max loss would still just be the premium that you paid for that long call.
Makes perfect sense. So basically, deep in the money option, delta close to one, kind of behaving like the stock essentially.
Exactly, yes.
Makes perfect sense. Yeah, never heard that one before actually, but makes a lot of sense. Thank you so much for clarifying that. Okay, and kind of switching gears a little bit in terms of option strategies. Anything in particular you'd recommend for investors looking to bet on not upside but downside? So basically looking to bet on a stock's decline.
Mm. So with that, of course, you can look at a short call. Usually there's, of course, a slightly more risk to it. So the max loss is unlimited if you are wrong and the share price just goes up. So if you're looking for something and you're a bit more risk averse, then you can always just look at a normal long put. So this would usually limit your risk to the premium itself that you're paying. And the possible profit on that would be basically just the difference between the strike and zero, minus the debit that you paid, of course, if the stock goes down all the way to zero. So on top of that, this would be the absolute basic in terms of on looking at stocks that are declining. The basic of that would be looking at a long put. And then you also get other defined risk strategies that you can look at, such as a long put spread, a reverse iron condor, or even a short call spread if you're looking for that. But in this case, the most simplest would just be a simple long put. You just pay the premium, and that's your max loss as well.
Makes sense. And just a quick kind of follow-up on that. So long put to bet on a stock's decline, what are the pros and cons of doing that compared to, let's say, simply shorting the stock itself and not using options?
Yeah. So biggest pro here would be that, like I said, your loss is limited to the premium. Whereas if you shorting stock, if the market moves against you, your losses can be limited, and especially if it continues to move upwards and upwards. Now, with shorting the stock, it also can require more capital, depending of course, what the platform or the broker would require you to put up for that particular position. Whereas with a long put, it's only the premium that you have to put up for that position. And with shorting stock as well, there could also be hard to borrow fees associated with a stock if you were shorting it, which could be charged on a daily basis as well.
Makes perfect sense. Unlimited downside if you short the stock naked, as the saying goes. Definitely something to
Mm,
watch out for. Okay, and then kind of, want to touch base on. So previously we've been sort of discussing more directional bets, and now let's say I expect a particular stock or a wider index for that matter to make a significant move, but I'm not sure about the direction. So let's say Nvidia on earnings day, could shoot the lights out again, pop, or could completely disappoint and the stock tanks. What
yeah.
option strategies are there out there that could kind of work in this scenario?
Yeah, so in this case, it usually depends on if you're looking at the stock now, if you do own the stock or whether you're not owning the stock, but you're not quite sure where it's going. So we can start off with if you do own the stock, then you can look at something like a protective put, just to put on that. So it's essentially just you have the stock and then you buy a put to hedge you against that downside. Obviously, if it goes in the favor, it goes up. You do have that profit from the shares. If it goes down, then you get the profit from the premium as well. And this would also then now, if you do not own the stock, if you're looking at maybe the index particularly, then you can look at something like a strangle or straddle. Now, both of these basically just consist of a long call and a long put. So the long put is there if it goes down, you'll make a profit. The long call is there if it goes up, then you make a profit. And the difference being between a strangle and a straddle is just basically whether it's on the same strike price or on a different strike price. And that usually just means how much you're going to pay extra on premium, particularly. Of course, if it's closer to being in the money, a higher premium, further, then less money. And of course, now what I mentioned earlier, difference being between the normal covered call and protective put is that with a covered call, it's not necessarily there to hedge you, it's to generate the additional income. With a protective put, it's more there for the hedging. If it goes down, then you do make a profit to make up for that loss of the shares.
Makes perfect sense. And I always hear about this kind of the inverse of a protective put where you've got some short sellers who short a stock but buy a out of the money kind of put option to protect against this risk that if the company gets acquired, stock shoots up and then they could end up losing a lot of money on their shorts, and that way if you buy a put can also kind of protect. So it kind of works in a similar way, I guess, but on an inverse basis.
Similar. Yeah, so in that case, if you are shorting the stock, then you could look at a call to long call to protect you, of course, for that upward trend.
Absolutely. And then, okay, that's all amazing. And before I kind of turn it to the audience for audience Q&A, and on that subject, for anyone tuning in and you have a question to our speaker, please be sure to put it in the Q&A box in Zoom. So really final question, kind of open-ended question really is if you have any, final tips for investors looking to trade options.
Hmm. So that's basically just quite a few things that I mentioned in the previous seminar as well. The biggest thing and the most important is always to know the underlying market that you want to trade. If you have no idea about Tesla or oil, then there's no point in you trading the options market if you don't know the underlying market. Understand, of course, that options are a decaying asset, and that means that time would work against you if you're long, where it would work for you if you're short. You need to then also understand the risks associated with options. And the last thing I would say is options are not just directional based compared to shares. It's not just if the price goes up, you make a profit. If the price goes down, you make a loss. There's a lot more that gets factored into the options price. So you need to remember that it also depends on time decay, on volatility, on client sentiment, bid and ask. All of those things also affect the actual options price. It's not just directionally based.
Amazing. All very important tips to keep in mind as you trade options. Thank you very much for that, Hannes. So I want to turn it over to audience Q&A. Like I said, please feel free to enter your questions in the Q&A box. Starting off with the most upvoted one comes from Peter. What are some ways for traders to implement these strategies around the US election? How can we look to benefit regardless of election outcome?
Yeah, so that's quite a difficult one and a broad one. So in that case, it depends on, of course, what you think the outcome is and how you think the market's going to react to that. If you're just looking to hedge, then quite a few things I mentioned here would be helpful. Protective put. If you just think that the market's going to go up, either up or down, you can look at a strangle or straddle. But it completely depends on the market that you want to look at and how you think that the particular elections is going to go to affect that market. The one thing that you do need to remember specifically when it comes to elections, that's a time of volatility. Now, what volatility does to options, it's going to increase those premiums, and it's going to mean that the options are going to be a bit more expensive. And then the day after, well, the day after announcement, the day after we know who was elected, that volatility is going to die down because people are now certain. That means there is going to be a bit of a volatility crush, and prices are going to drop a bit with options. So that's usually something that would benefit short options holders compared to long options holders because of that, just the decrease in volatility, meaning the decrease in options pricing.
Thank you very much. And our next question is basically asking, can I use a UK-based platform like IG to trade options? I thought options are not possible from the UK, and we need to use a US-based platforms like Interactive Brokers or TT.
Yeah, so this is definitely possible for a UK-based platform. So we recently did launch the US options and futures platform, which is specifically for UK clients trading on the US exchange for options. We offer equities, options on equities, options on futures. It's a platform specifically made for that. You can do the options strategies on there as well. So all of these are exchange traded. So there is that assignment risk that you need to be aware of as well. As long as you capped and you do have your defined risk strategies. We also then just have the OTC side of it. So with Spreadbet and CFD, we have our cash settled options that we offer there as well.
Amazing. Thank you very much. And then the next question is asking for any advice on strategies regarding closing option positions before the expiry date.
So strategy specific, it depends on the type of strategy that you're putting in, but usually you also need to remember further out from expiry, the more extrinsic value, the more time decay, and possibly some volatility is on that option. Whereas the closer you get to expiry, there's going to be a lot less of that. So you need to take that into account on when you want to close a position and what you're looking to get out of it. If you're just looking to trade the options price, then it depends on of course where the price is, but on the day of expiry the option price is going to be a lot more volatile and a lot more sensitive to the underlying share price, of course, moving. So you also need to be aware of that. You can possibly be in a profit, and then you're thinking of maybe leaving it to expire, and then next thing you see, you're on a loss. So in that case, you just need to be aware of the risks associated firstly to your position and also what's going to affect your options price up until expiry.
Amazing. Thank you. And then the next question is asking, how deep in the money does a poor man's covered call need to be? And how do you decide the strike price of the long call for the poor man's covered call strategy?
Yeah, so in this case, it's like you mentioned earlier. You need to try and get a deep in the money long call that has got a delta of close to one, because that's going to mimic the movement of the underlying. It's essentially synthetic exposure of the shares that you do have, and how deep in the money would usually depend on what you are comfortable with paying for that particular premium. As I mentioned, the max loss is the debit that you would pay. So if you're looking at, obviously, the further down, the deeper you go into the money, the higher that premium does go for a call. So you just need to be aware of how much are you willing to lose on that particular poor man's covered call, and then based off that, choose your strike price, choose your premium, and then just ensure that that delta is close to one, of course.
Makes sense. Thank you. And then next question comes from Asha. I'm currently reading The Complete Guide to Selling by James Cordier and Michael Gross. As a newbie to options, the book is brilliant, but I'm wondering if you would recommend any books or articles to read for people like me who are new to trading options.
Yeah, so um, usually not that big of a reader when it comes to the financial markets and all of that. I'm a firm believer in anything that you need to know is pretty much out there already. So there's several type of websites that offer free academy courses. There's YouTube videos. Um, Most of what I know and what I've learned so far can just be obtained from Tasty Trades platform, Tasty Lives platform, IG Academy's platform. All of that is available to you, and all of it's usually free as well. So you can read up a lot about it, and you'd be able to get most of the information you need from all of these different websites, different YouTube videos, seminars as well, if you're looking to do that. Stuff like Tasty Live, Bloomberg, all of that has the type of information that you are looking for. So I wouldn't be able to recommend an exact book, unfortunately. But as I said, there are different websites that have more than enough information on options if you are looking.
Thank you. Next question comes from Sarah. What are the major mistakes traders make moving into options? I'm already confident in actively trading. What are the big things to watch out for?
I think the most common mistake I've seen so far would be clients usually go onto the platform and they immediately just start buying options, thinking that it's a surefire way to make money because all they hear is limited loss, maximum profit. And they immediately just go onto the platform, they buy a call, they buy a put, and they're convinced that they're going to be right. And then if the stock price doesn't move, they end up losing all of that. And now they demoralized, they don't know what to do, they lost all of the money, and now they just get out of options trading. So you need to understand that options is going to be the same as the underlying market. There's a very small chance of that stock actually shooting up or shooting down that much within a short period of time. And you need to, like I said, you need to understand what is going to affect that specific options premium. So a lot of the time there are reasons why there are strategies. The different types of defined risk strategies are there to, yes, it might cap your profits, but then it's also there to maybe increase the chances or the probability of being correct, and also maybe just decreasing the downside risk that you do have.
Makes perfect sense. And then we have another question regarding the US election. So, in the case of a highly contested or delayed election outcome, what option strategies would you suggest for managing portfolio risk?
So yeah, in that case, of course, as you understand, I wouldn't be able to provide any investment advice or recommendations in this case. But if you are looking at that, again, depends on what you think the markets are going to look like with that. If you think the markets are not going to like that, if you think it's either going to go absolutely up or down, then like I mentioned, strangle, straddle, that would work in this case if it's going to go extremely up or extremely down. If you just think that the market's going to be patiently waiting for the results and it's pretty much just going to stay where it is, then you can look at an iron condor. So that's about the equivalent of a short strangle or short straddle, but where you cap your losses as well. Maybe a bit more advanced, but also something that you can look into. But in terms of managing the portfolio risk, you would need to have a look at your overall portfolio and see what you think is most vulnerable to the US elections. Based off that, then decide what you want to risk, what you're willing to risk, and what you don't want to risk at all. And then based off that, look at protective puts, look at something like a strangle, straddle, even if you just want to make a profit. But based on what's in your portfolio, try and see what you're comfortable with losing and how you think the market's going to move. Based off that, then you can use options to hedge your portfolio.
And I guess this is also going to an earlier point you made on trying to understand the underlying markets before trading options, right? So before trying to use options to trade the US election, you kind of need to have a view on which assets in the bond market, stocks, even the dollar, etc., you expect to move and where based on the election outcome, right? You need a view on that first before you can think about which instrument to trade that view.
Exactly, exactly. So if you know nothing about the US elections, then why are you trying to then make money off of that? Why are you trying to make a profit of that? If it's purely just for hedging, then of course I understand that. But then make sure you still do your research based on what stocks you think are particularly vulnerable to the particular US elections.
Amazing. Thank you. And next question is basically asking what are some scenarios where it's worth considering deep out of the money options?
So deep out of the money options would usually be depending on whether you're long or short. That can Yeah, it depends on what you think is going to happen essentially. So if you're looking to do let's say you do a deep out of the money long call. That's if you're fairly certain that the price is going to increase because options are essentially a leverage product. If you're buying something that's deep out of the money and the price does shoot up for a long call, you could be looking at maybe possibly a slightly a higher profit on if you were just looking at something that's normally in the money that's got less extrinsic value on top of that. The other side, if you're looking at just the short side of it, if you're looking to do a short call that's severely out of the money, you might not receive as much premium, of course, but in that case, you can just wait for time decay to do its thing. If it's severely out of the money and the share price isn't moving as much, time decay it's going to start doing its thing, and that the price of that share price, the option premium, is just going to slowly decrease and decrease until it gets close to expiration, whereby it could be close to worthless, and you could be looking at a profit based on that. So it's usually just how comfortable are you with making maybe less money and maybe more risk averse compared to, of course, if you're doing something closer to the money, you sell a premium there, you got a higher chance of maybe being wrong, maybe being assigned, but you would for that you get compensated for a higher premium.
Makes sense. And another question basically asking if you can shed some light on the tax implications on options in the UK.
Yeah, so in this case, it depends on what platform and what you are looking to trade. The normal US options and futures that we offer, as it is directly on the exchange, that should be subject to capital gains tax. But in that case, again, wouldn't be able to advise on tax matters. In this case, you would need to check with a tax advisor to ensure about that. But if you're trading options on a spread bet, that's a completely different scenario. But on the normal CFD, if it's just OTC and it's cash settled, and compared to US options and futures, if you're trading on the exchange, that should just be subject to capital gains tax.
Thank you. And then we have a question asking, what are some of the most common mistakes you see experienced options traders make, and with a heavy emphasis on the experienced traders?
That's a bit more difficult question. I think I've seen less and less experienced traders. But with options, I think that's a very good question. I think more when it comes to the experienced traders, especially if they've got maybe a slightly bigger portfolio, is they're more than happy to just sort of let it run. So even they're much more comfortable with just doing a short call and just doing a short put and getting that premium. And then if they do end up losing a lot more, then it doesn't usually benefit them. So I think more on the experience side, it would be I've seen a few just selling the naked calls, selling the naked puts without that having that hedging side of it, without having the shares or the long call to perhaps just hedge you and cap your losses a bit. Of course, that does decrease the premium a bit, but it also protects you on that downside or that upside.
Amazing. And perhaps one final one before we conclude, is selling options more profitable than buying options in the long run?
Yeah, so I'm feeling like I'm repeating myself here, but just saying that, of course, it's not investment advice or recommendation or anything like that. Um, but in this case, as I mentioned, if you're looking at purely from just a, let's just say, a objective view of a stock that's not moving, that is just sitting there, it's trading at around $8 to $10 per share, not really increasing or decreasing much. If you buy a long option for at a strike price of 11, let's say at $11, when you leave that long option, it's going to slowly decrease and decrease. Time decay is going to do its thing. There's going to be less time for you to be right. It's going to get closer to expiration. So if nothing else in the market happens, you will end up losing money on a long option. Whereas with a short option, if you sell that at $11 and the price stays there between 8 and 10, 8 and 10, and time decay does its thing, you're going to end up making a profit. So even if you look at it at the viewpoint of if the market doesn't move at all, then short options would work in your favor, as time decay would still just be essentially decreasing the value of that option. But again, depends on the market specifically that you are trading. You need to understand that something like Ford, that's maybe not as volatile as compared to Tesla, the options are going to reflect that. The options would be the same as the underlying market. So you need to understand the underlying market before you just decide on whether long options or short options are better for you.
Amazing. Thank you so much, Hannes. I'm afraid that's all the time we have today. Just before you all go, I know we've had some questions about the US election. So actually, if you are interested in that, please join us on October 29th, where we will be back with the experts from IG for an election special as they share what investors need to know before the US heads to the polls. So you can RSVP for your free ticket using the link shared in the chat now. And also, as you leave the event today, a pop-up survey will appear on your screen. Please take a few minutes to let us know what topics you're interested in hearing about at future events. Hannes, on behalf of myself, Finimize, and the entire Finimize community, thank you so much. I loved your insights, extremely useful, extremely valuable, and very practical. So thank you very much.
Perfect. Thank you very much for having me. It was a pleasure.
A pleasure indeed. Thank you everyone for joining, and I look forward to seeing you at another event. Thank you very much. Bye-bye.
Thank you. Bye.